Welcome to this explainer. Today, we're pulling back the curtain to decode how business finance actually works. No complicated jargon, no intimidating math, just the real, behind-the-scenes breakdown of what keeps a company alive, how it scales, and honestly, why so many ultimately collapse. Let's dive right in. You think profit means success? Well, not exactly. Imagine you're building a business. Everything feels like it's clicking. Customers are buying, money is coming in, and you're feeling on top of the world. But then one day you log in, check your bank account, and realize you are almost entirely out of cash. Wait, how is that even possible? It happens because making money and managing money are two completely different skills. A company can look highly profitable and still run out of cash. Think of business finance kind of like the dashboard of a car. Without these dials, you might be flying down the highway at 80 miles an hour, but you have absolutely no idea if you're about to run out of fuel. You don't need to be a certified accountant to drive the car, thankfully, but you do need to understand a few core concepts just to keep the engine running.
Which brings us to part 1, the illusion of revenue. This is exactly where even the smartest founders fail. They confuse what people see on the outside with what's actually happening behind the scenes. Watch this graph. Revenue is the total money coming in, right? It's that big, flashy number everyone loves to brag about at dinner parties. Let's say you sell $10,000 worth of products. Wow, looks fantastic on paper. But to make, ship, and market all those products, your costs are $8,000. So, what is your actual profit? It's just $2,000. The surprising part is how many founders completely lose sight of this. Revenue looks impressive to the outside world, for sure, but profit tells the absolute truth. You can have massive, record-breaking sales and still completely fail as a business if this final number isn't healthy. This number explains everything.
Now, part 2, the silent business killer. Because even if you have profit, there's a deeper problem lurking. We're talking about cash flow, the physical money moving in and out of your accounts in real time. Let's look at a story that plays out every single day. Imagine an agency lands a massive deal. They sell $20,000 worth of services on day 1. They are thrilled. But as is super common in business-to-business sales, the customer's contract says they don't have to pay for 60 days. Now notice what happens on day 30. Rent is due. Employees need their salaries. Suppliers are demanding payment right now. The business is highly profitable on paper, but in reality, they are completely out of cash. And this brilliantly illustrates why folks in the industry say cash is oxygen for a business. Think about it. You can hold your breath for a little while. But if the actual oxygen, the cash, doesn't hit your lungs when you desperately need it, the business suffocates. And that happens regardless of how much profit you made on a spreadsheet.
Part 3. 3 essential financial reports.
So, how do we stay in total control and not suffocate? We use 3 ultimate reports. Try not to think of these as boring accounting chores, but rather as the 3 primary dials on your dashboard. What's really cool here is how simple they actually are when you strip away the corporate jargon. First, you have the income statement. It tracks your revenue, expenses, and profit. The core question it answers is simply, did we make money? Second is the balance sheet. This lists your assets, liabilities, and the owner's value. Basically, it answers, what do we own and what do we owe right now? And third, the all-important cash flow statement. This tracks the actual physical cash movement we just talked about. Its core question is, can we pay our bills today? Together, these 3 dials tell the complete, unfiltered story of your business's health.
Moving on to part 4, your break-even point.
Once your dashboard is set up, this specific metric acts as your true north. Break-even is the exact moment where you earn just enough to cover all of your costs. You haven't made a profit, but you haven't taken a loss either. You're sitting perfectly at 0. So why does this matter so much? Because once you calculate this exact threshold, every single business decision becomes incredibly easy. The guesswork is gone. You immediately know exactly how much you need to sell just to survive. You know precisely when you can actually afford to hire that new employee, and you know exactly when it's safe to invest in new equipment. But finding that true north requires strict discipline. You have to maintain a ruthless budget. You must separate your fixed costs, things like rent, which never change, from your variable costs, like shipping materials, which jump up when you sell more. You literally have to track every single cent. Why? Because finance rewards attention. If you ignore the small leaks, they will eventually sink the entire ship.
Part 5. Funding your growth.
Now, what happens when things are going incredibly well? Scaling up means buying more inventory or expanding your team. And growth? Well, growth always requires money. When businesses decide to grow,
They usually choose between two main options. Option 1 is debt. This is where you borrow money from a bank or a lender, and you repay it over time with interest. You keep total control of your company, but you have the constant pressure of those monthly payments. Option 2 is equity. This is where you bring in an investor and give them a percentage of ownership in your company in exchange for their cash. You don't have to pay them back monthly, but you've given away a piece of your future profits and a piece of your control. Neither option is automatically good or bad, but a smart, confident leader has to understand the true long-term cost of both before making a move.
So the absolutely crucial point to take away from this entire breakdown is this. Business finance is not about memorizing complicated formulas. It's about clarity. It's about knowing your numbers, tracking your cash, and reviewing everything weekly. Because the reality is, businesses rarely fail from a lack of good ideas. They fail from a lack of financial control.
Now you know how business finance actually works. You have the tools to read the dashboard and keep the engine running. But it leaves us with one final critical question. The next time you look at your company's bank account, are you just staring at the speed you're traveling, or do you finally know exactly how much fuel is left in the tank? See you in the next breakdown.